The financial world has been buzzing with news of JPMorgan Chase's recent acquisition of First Republic Bank, a troubled bank that was taken over by the U.S. government during the 2008 financial crisis. This major move by one of the biggest players in banking is raising questions about what it means for both JPMorgan and the industry as a whole. In this video, we'll dive into why First Republic Bank was taken over, how JPMorgan plans to integrate it into their operations, and what impact this could have on consumers like you. So grab your coffee and join us as we explore this exciting development. In 2008, First Republic Bank was one of the many banks that struggled during the financial crisis. As a result, it was taken over by the U.S. government in an effort to stabilize the banking industry. However, this takeover did not mean the end for First Republic Bank, as JPMorgan Chase saw potential in acquiring it. JPMorgan's decision to purchase First Republic Bank is part of their overall strategy to expand their presence in certain regions and markets. With this acquisition, they gain access to a new customer base and are able to offer them more products and services. While some may be concerned about what this means for competition within the banking industry, others see it as a positive move towards consolidation and stability. It remains to be seen how other players will react and whether or not we'll see more mergers or acquisitions down the line. JPMorgan's purchase of troubled First Republic Bank shows their commitment to growth and expansion despite any challenges faced along the way. In late 2008, the United States government was forced to take over First Republic Bank due to its financial instability. The bank had been struggling with high-risk mortgage lending practices and other risky investments, which ultimately led to its downfall. As a result of this takeover, JPMorgan Chase saw an opportunity to acquire the troubled bank. First Republic Bank's troubles began when it became heavily involved in subprime mortgage lending. This type of lending allowed borrowers who would not normally qualify for traditional mortgages to obtain loans with lower interest rates than what they would have received otherwise. However, these types of loans often carried higher interest rates and fees that made them more difficult for borrowers to pay off. The housing market crash in 2007 caused many homeowners to default on their mortgages, leaving banks like First Republic Bank with large numbers of non-performing assets on their books. This left the bank vulnerable and unable to weather the storm without government intervention. The U.S. government takeover was necessary because if First Republic Bank had gone bankrupt, it could have triggered a chain reaction throughout the banking system that could have resulted in widespread economic collapse. By stepping in and taking control of the situation, regulators were able to stabilize the industry and prevent further damage. While unfortunate for those directly impacted by First Republic Bank's struggles, the government takeover helped prevent greater harm from being done and set up JPMorgan Chase for future success through their acquisition of a valuable asset at an opportune time. JPMorgan Chase's acquisition of First Republic Bank is a significant move for the bank. With this merger, JPMorgan will have access to First Republic's high-net-worth clients and their assets, which can significantly grow their wealth management business. Moreover, this acquisition allows JPMorgan to expand its presence in California, where First Republic has a strong foothold. By strengthening its position in the West Coast market, JPMorgan can effectively compete with other major players like Wells Fargo and Bank of America. Adding First Republic's mortgage lending business to their portfolio also enables them to tap into the booming housing market and generate more revenue streams. However, acquiring a troubled bank comes with risks as it exposes JPMorgan to potential losses from non-performing loans and operational issues that may arise during integration. Still, with its vast resources and expertise in managing complex acquisitions, JPMorgan is well-positioned to make this deal work for them. While there are inherent challenges associated with any merger or acquisition activity of this magnitude, if executed successfully, it could be a game changer for JPMorgan Chase. The acquisition of First Republic Bank by JPMorgan Chase is a clear indication that the banking industry is facing significant changes in the wake of COVID-19. The pandemic has put immense pressure on banks to remain competitive and profitable, which has led to consolidation within the industry. The acquisition shows that larger banks are looking for opportunities to expand their market share by acquiring smaller institutions. This trend is likely to continue as banks seek ways to diversify their portfolios and increase their revenue streams. However, this consolidation could have negative consequences for consumers. With fewer options available, customers may find it harder to access financial services or get favorable rates on loans and other products. Additionally, competition between remaining firms may decrease, leading to reduced innovation within the industry. This merger highlights a need for further regulatory oversight in the banking sector, particularly when it comes to ensuring healthy competition and protecting consumer interests. Consumers are likely to feel the impact of JPMorgan Chase's acquisition of First Republic Bank in a number of ways. One immediate effect could be changes to account fees and interest rates, as JPMorgan seeks to integrate its new acquisition into its existing operation. Customers who had accounts with First Republic may also experience changes in customer service and banking products offered, as the bank is integrated into the larger entity. Some customers may see this as a positive development if they benefit from access to more services or better rates. There could also be longer-term effects on competition within the banking industry, with some analysts suggesting that consolidation among large banks could lead to reduced choice for consumers. However, it remains unclear whether this trend will continue following increased regulatory scrutiny of mergers and acquisitions in recent years. While there are potential risks associated with such acquisitions, there are also opportunities for consumers if JPMorgan Chase can successfully integrate First Republic Bank into its operations without disrupting current services or causing undue harm to consumer interests. In summary, JPMorgan Chase's acquisition of First Republic Bank after the U.S. government takeover marks a significant change in the banking industry. The move is expected to bring stability and growth opportunities for both banks, while also setting a precedent for future mergers and acquisitions within the sector. The takeover highlights how interconnected the banking industry and government are, as well as how vulnerable even large financial institutions can be during times of crisis. While it remains to be seen how this acquisition will impact consumers in the long term, there is potential for increased competition and innovation among other banks striving to keep up with JPMorgan Chase's expansion. This event serves as a reminder that no institution is too big to fail or immune from market forces. It also demonstrates that adaptability and strategic thinking are key factors in navigating turbulent economic times.